Hello and welcome to the Adansonia Capital Global Opportunities Portfolio Update for June 2024. This is our disclaimer. Please read it at your convenience. To move forward, I will take it as read. We haven't done an update for 2 months, so I'm just going back to cover off how the portfolio performed in April. In April, the portfolio outperformed a falling market. We outperformed by 17 bips. And essentially, the rolling performance of the portfolio continues to be pleasing over longer periods, as you see in this table. For the month of May, the portfolio underperformed a strongly rising market. We generated 0.44% versus the market up 2.2%. I will go through basically why we underperformed the market for May and what we've done in response to this underperformance and the outlook that we have. So, talking about why we underperformed in May, the first slide here looks at the performance of the S&P 500, the equal weighted S&P 500, Nvidia, and Apple. And the fact of the matter is the market is being driven to new record highs on an ever smaller number of large mega cap stocks running on the AI theme. And we do not see any fundamental value, particularly in Nvidia, which is the brown line, and Apple, which is the magenta line or the red line. So effectively, Nvidia for the month of May was up 27% in US dollar terms. Apple up 13% after basically announcing it had a viable AI strategy at a conference. We just don't see any fundamental value in these shares, and we will not be basically buying these shares at these levels or chasing these shares. Because of the weight of these shares in the US index, it basically has lifted the market to new highs, as I mentioned, and the green line is the S&P 500 index, so the performance of the S&P 500 index in US terms for the month of May, which is up 4.8%. But if we diminish or we take out the market cap or the market weight of Nvidia and Apple and other shares which are run, effectively the blue line, which is the equal weighted S&P 500, has basically performed more modestly for the month, 2.6% in US dollar terms. But it's not just about us not having these stocks which are running. We also had a few stocks in May which performed poorly, and I'll just touch on these. So in the latest results, LVMH sold off on diminished demand out of China for luxury goods, and in particular, this was in the Moet and Hennessy sector, in the alcohol sector, where essentially there's not a lot of champagne corks being popped in China at the moment, and I think sales volumes there for alcohol were down around 12%. What's also impacting the stock at the moment is that there are elections pending in France. And essentially, the centralist party that Macron currently wins at the moment seems to be losing some of its advantage, particularly to a far right party. And what we're seeing is that the policy of the far right or even the far left parties in France are big spending, and there is a fear that they will basically tip the French economy. And essentially, that's been impacting on bonds and the CAC 40 or the French market. So essentially, there's a macro overlay at the moment in France, which is weighing on shares, as well as some micro issues presently with LVMH. In saying that, for LVMH, everything's in the price. We value the stock at a bit over €900. It's currently around €700, and really, it's the same for all of these stocks. For Porsche and for Uber, they're facing some headwinds at the moment, but essentially it's in the price. And really, for all three of these shares, we've gone back and reaffirmed our investment hypothesis for all these shares, and there is value there, and it's in the price. Porsche, so again, the same thing, essentially being weighed on at the moment by a sluggish Chinese economic recovery and the prospects of lower sales at the moment in China, and also the impact of higher inflation interest rates on the sales of luxury cars. In saying that, the metrics or the results for the 9 months for Porsche were in line with annual forecasts. And saying that, though, the company did warn that these luxury goods could be impacted by these the factors of higher inflation and interest rates. What's also impacting Porsche is that they've warned that their operating margin could slip this year. They generally target a 17 to 19% target for their operating margin. However, after a $2 billion capex on the new EV rollout, particularly the new electric Macan, operating margins this year are likely to slip a little bit from their 17 to 19% target down to 15 to 17%. Again, all in the price. And as with LVMH, there's also a macro overlay at the moment impacting Porsche, where essentially you've seen that Brussels or the EU have imposed import tariffs on Chinese EVs into Europe. And there's a threat that essentially China might retaliate on the European car manufacturers and the sales of European cars into China. And essentially, the Germany and the German car makers have been lobbying very hard against the imposition of these tariffs on the Chinese EV imports, but they had no luck in basically stopping them. Lastly, Uber, essentially, first quarter results showed lower than expected ride and delivery bookings. Only at the margin, it was a little bit disappointing. It's also been hit on comments or revision that's been expressed by Elon Musk to offer a robo-taxi service by Tesla. And lastly, Uber is a company that has been investing very, very heavily to get to critical mass and profitability, which it has done. But it basically announced a shock loss at its result, and that was due to a write down of some of its investments. When you basically look through that abnormal, the result was towards the low end of consensus, or low end of expectations. So again, as I mentioned before, these stocks have dragged on performance for May, but generally, the headwinds which they're currently facing are in the price. And we're still happy with the portfolio positions, and essentially we continue to believe that the investment hypotheses for these three stocks are still intact. Just looking also at some of the macro over the month. So US CPI in May was largely flat on April at a 3.3% rate. The core CPI, which excludes food and energy, was at 3.4%, which is the slowest rate in 3 years. However, in all of that, inflation continues to run above the Fed's 2% target, and the US Fed's dot plot is now indicating, or is now forecasting that there'll only be one 25 bip rate cut in 2024, not 3. We believe there might be 2, but still at the moment the dot plot is looking at 1. As I mentioned before, equity indices are being driven to new records by an ever smaller number of mega cap stocks running on the AI theme, and they're running beyond fundamental values. Case in point, I think that the Nvidia share price is currently $135 after the 10-for-1 split. Really, if we throw the kitchen sink in Nvidia, we're getting around $103 a share. Just can't justify the current price. I've put down a few metrics for the S&P 500. It's trading at high multiples versus historic averages of 22.5 times for calendar 24, just under 20 times for calendar 25. It needs rate cuts to help justify these current levels. The market needs a low cost of equity, and effectively these rate cuts are coming further out. They're basically, as I mentioned, 1 at the end of this year, maybe 2. So for the next 5 to 6 months, we believe the market is just going to churn around these levels. Very, very hard to see, continued performance with these rate cuts being delayed, and effectively, the market being driven by a couple of shares, where now they're trading well past fundamental values. So what have we done? Essentially, long story short, we've reduced our exposure to the market. So essentially, we've lifted cash. We did that by exiting our holding in Shell. So Shell has performed okay, but essentially with a weak Chinese economy, it's hard to get particularly excited on the oil price. Oil price is currently trading a little bit above long-term average levels, around $85 a barrel. That's obviously being helped still by obviously some of the political risk issues, or the bottlenecks from the political risk issues around the current wars, or the political unrest that we're seeing at the moment. But as I said, hard to sort of see oil price driving Shell further. So we exited that position. We reduced Brookfield. Brookfield essentially had a 7% weighting in the portfolio. It's a great stock, but we essentially see more value in Amazon and Alphabet, which had a lower weighting, and accordingly we basically just adjusted the weightings to reduce Brookfield, which has lower upside, to Amazon and Alphabet, which is higher upside. So we trimmed Brookfield, and the same thing, Taiwan Semiconductor Manufacturing Company. The stock has run in line with, well, not in line, but basically it's been caught up in the draft of the AI companies. It's fundamentally a lot cheaper. But look, as I said, the target has it traded well past target just by its relative outperformance. So we trimmed that and took that back to target and took a little bit more off the table. And with that, we increased our weightings in Amazon and Alphabet. Amazon, we believe, is over 30% cheap, the current levels. And we also obviously increased cash. So we increased cash from around 11.5% to 15.5% cash. And now we hold 13 stocks in the portfolio. So we're taking a more defensive exposure to the market at the moment, which we believe is running beyond fundamentals and needs these rate cuts, which are being delayed because of a resilient economy, and effectively it's hard to see what's going to continue to drive the market higher from these levels. Anyway, that is the end of our presentation. As always, our contact details are at the front. Please feel free to contact Tony or myself at any time. Our mobile numbers are there, or obviously use the Adansonia inquiries line. And I will be in touch again in a few weeks for the July update. Thank you.